Thank you. I'm Nina. I'm part of AlphaQ Venture Capital. We are building a venture capital fund of fund that aims at making venture capital accessible for everyone. So let me start with some background. The pandemic has upended many aspects of our lives, and at the same time, it has also led to unprecedented innovation. Technology was one of the clear value drivers and has undergone 5 years' worth of progress within the last 18 months. At the same time, people did not only stay at home, work remotely, and do online shopping, they also reflected about life and opportunities. A recent study in the US has shown that people are increasingly open to try for new opportunities that also fit better with their life situation and their personal interests than ever before. And that's also a big opportunity for entrepreneurship. Another study by Deal Room has found that in Scandinavia, the Nordics, impact companies attract, on the startup size, 25% more job applications than non-impact companies. So this is why we believe that there is a fundamental shift happening, and it's a great opportunity for entrepreneurship overall. And that's also what we see across the globe. So entrepreneurship is gaining momentum. And at the same time, there is more capital in the market than ever before. We also saw a lot of increases in later stage and growth stage financing, which in turn has also led to the highest number of unicorns ever, now amounting to more than 900 across the globe. And what is also a nice fact is now we also see around 150 impact unicorns out of that. What is also remarkable is that half of the capital that was deployed within Q3 21, and overall we're talking about 158 billion this quarter, Q3 2021, half of that went into the United States, followed by Asia, that saw the largest number of deals, and then Europe. But what's also interesting is that we see large growth rates in Latin America when it comes to venture financing, but also impact financing. New tech funds are being formed in Africa, but also Southeast Asia. Overall, venture capital has grown by more than 600% over the last 10 years and is likely to become a $1 trillion market over the next years. Yet you will say that's a big number, but when you look at the amount of new businesses that need to be created to really foster sustainable change, it's not that much. And on the other hand, when you look at other asset classes where primarily institutional investors deploy capital, it's also not much when you look at private equity, for instance, which is a $4 trillion market. And there's one group who didn't have the benefit from the returns that have been created through venture capital in the last years, and those are the European savers primarily, that rely to a certain extent still, there is private solutions as well, on public retirement insurance. And with low interest rates remaining, as well as inflation heating up, those pension gaps are likely to materialize even more. In the UK, it's less pronounced, but also there was a study by the British Venture Capital Association that found that out of the 11 billion that have been attracted by UK tech companies in 2020, only 4% went to local savers. So we also have a question on domestic funding of innovation as such. Europe is quite at par when it comes to early stage funding compared to the United States and Asia, but is clearly lagging behind on growth and later stage financing. At the same time, it attracted 13 times more capital than 10 years ago. we also have new players in the market, and that's also what is causing a new dynamic in venture overall. So we see larger valuations driven by crossover funds, private equity companies, but also asset managers, because tech companies have become more mature and there is more competition. At the same time, that also creates competition at the early stages where more funds are being formed and founders can counter-select investors. So what a founder seeks to find is an investor that comes in, rolls up the sleeves, and helps them grow their business from ground zero through the network they can bring and the experience they can bring beyond capital. And that's also why emerging managers are coming up more and more as they offer niche strategies to achieve that, though for those group of investors, it's not always easy to attract capital. What is also an important aspect of venture capital is that this is a community and that ecosystem got connected more and more over the last years. And these people have been working with each other, backing each other, and founders become serial entrepreneurs and they become investors. And that's also why for a large institution, it's not so easy to tap into that market, because you also need to have access to it and you need to be part of the community and look behind the dynamics that are being created. So at AlphaQ, we believe that venture capital should not only be accessible to a few people, because given the riskiness of the asset class, usually only high net worth individuals, at least in Germany, can make a contribution. And this is why we decided to create a venture capital fund of fund, because one measure of risk mitigation is simply diversification. So AlphaQ is a German stock corporation that will prospectively be listed over time. And the objective is that through just one stock purchase, people have access to a well-diversified portfolio of startup companies. We need to start small, so we are set up our legal structure. We have received our license from the German regulator. We also have signed numerous LOIs with reputable venture capital firms, and our objective is to now reach 100 million in private funding as a first milestone, and then move on and hopefully achieve our long-term goal over time, because sufficient diversification also comes with size. We will allocate 50% to emerging managers, 50% to established ones with a proven track record, and then diversify across stages, sectors, and geographies. On geographies, we will have a certain overweight on EMEA, because this is actually where our network is the strongest. And yes, we also look at SDGs when we choose our target funds, but we don't look at the length of their ESG policy or the number of boxes that they can tick in terms of frameworks. We look at our target funds. We look at the team and the change that they can bring all together, which needs to go across all these SDGs. And when you think about what needs to happen, it's about real sustainable alternatives and paradigm shifts. And that's much more likely to come from startups than large corporates. The capital is there, also in Europe. If we were to mobilize just a fraction from the asset owners and give it to the innovation economy, whilst at the same time all the savers can make a contribution but also benefit from an uplift in their account, this is where we seek to build a bridge. Thank you.